Friday, 10th of January 2025. Trade review. I will be covering a trade that I took on NFP Friday in the Nasdaq and specifically look into the concepts that I used to derive at that trade, which was utilizing the opening range gap and first presented fair value gap to target the daily external range liquidity draw. Starting off with the daily chart, which is where my analysis started from. I derived at the daily bearish bias on the basis of internal range to external range liquidity. I anticipated price to move from this bearish volume bands, which is internal range liquidity, down to this old low, previous week's low, which is external range liquidity. Couple that with the fact that we had a change in state delivery here and a market structure shift here. I at least anticipated the market to be on the near-term bearish. However, I did not look for an immediately outright reversal, considering that we are in very bullish long-term order flow on the monthly, the weekly and the daily chart. I also looked at the fact that we are trading down from a premium, which is derived from this dealing range high, down to a discount, which I specifically looked for this dealing range low, because it took out sales at liquidity here. And defining the dealing range from this low to this high, you can see that the market is trading down from premium down into a discount, and this is liquidity that is resting around equilibrium, maybe slightly in discount. So I thought there was a very likely probability of price reaching down to that level. Why did I not pick this dealing range low, this low as a dealing range low, up to this dealing range high? Well, specifically for reasons that we are in very extremely bullish order flow, meaning that I don't look for the market, I don't look to pick a top in the market. So when I anticipate a retracement of some sort, I don't pick the most, like, if you would look at this is the most obvious low, but I would not pick for this low as a dealing range low, because that means I would be anticipating a more significant decline lower into discount, and considering you are in very bullish order flow, I'm not looking for that. So that's why I picked this perhaps less obvious low to derive at the dealing range low, because it just gives me a smaller retracement, which I think is more likely in very bullish order flow. And whenever it takes out this low, for example, or eventually this low, if it does so, then I would refer back to this low as a dealing range low and can derive discount and premium based on that dealing range. But for now, I'm defining it from this dealing range low, just for the reasons that I don't look for a market to top. I'm not specifically trying to pick the top in a bullish market. So that's why I did that. Going back to internal range to external range liquidity draw, notice how very simple it is to derive a daily bias just on these two components. Just anticipate the market to trade up into this bearish volume bands on the daily chart and then to sell lower towards these red equal lows. Very simple, and this in itself gives me the daily bias being bearish, so I can look for intraday setups that are short. That's where my main focus lies. And one more thing, I see the concepts of IST as like envision them as a sort of pyramid, and then the lower portion of the pyramid where everything is built on, that is defined by a few key concepts. And I think internal range to external range liquidity is one of those key concepts for me, where on everything is built, every trade that I take has that component in it. Another one is like premium and discount, so the dealing range is another one of those key concepts. Then dropping down into the 50-minute chart, specifically look into the time frame alignment, daily, 50-minute, and then a 1 minute. Of course, I refer to other time frames as well, such as the 4 hour, the 1 hour, the 5 minute, everything in between, but this is where I mainly derive my setups from, using this time frame alignment. I don't even need to look at the 4 hour and 1 hour, but I still like to do so for extra support of my idea. So just in the 1 hour, I really like to look for those weekly profiles and having that in alignment. But in itself, a daily to 15 minute to 1 minute is all you really need. So what I look for in a 15-minute chart is a market maker model in the direction of that daily external range liquidity draw in this case. So I'm looking for a market maker model in the direction of my daily bias. That's what I was trying to say. So in this case, my daily bias is bearish. So what I then look for is for a market maker sell model on the 15-minute chart. And I specifically like to wait for the market to go into the sell side of the curve. So in essence, I can trade the smart money reversal on a lower time frame. So once price takes out the buy side liquidity here, I can drop down to the 1 minute chart and try to get an alignment there. But yes, that is an option. I sometimes do that. But the only caveat to that is that you can get, well, caught is perhaps not a good word, but I can't really think of a different one right now. But you can get caught up in a retracement on that 15-minute chart. And if you will be engaged on a 1 minute, you will be seeing a deep retracement or optimal trade entry. And that could squeeze you out if you're entering higher up into the premium range or just beneath it. And that is possible, but if you then overstaying your welcome, so if you would be entering short on the 1 minute in this upper portion, and you would be aiming for these lows, for example, then you would get caught into a sharper retracement, which if you had not managed it accordingly, could have stopped you out. So generally, I like to enter on the sell side of the curve itself. Of course, this is the sell side of the curve once the turn takes place here, but I like to, in the market maker sell model on the 15-minute chart, I basically like to engage on the stage of distribution, such as this one here. This one was another one, but I specifically dive into this one. So here we are on the sell side of the curve in this 50-minute market maker sell model, chasing the state delivery here. Already showed significant displacement lower. You can see that as the smart money reversal. This then low risk sell. I would define the stage 1 distribution here. Market then drops lower and then retraces up into this bearish breaker for the second stage of redistribution of this market maker sell model as part of a larger, higher time frame market maker sell model. That's why we don't have a very clear defined original consolidation on this time frame, but that's not necessary. I'm just looking for the sell side of the curve here, and then I look for the same thing that I looked on the daily chart, which is either internal range to external range liquidity or external range to internal range liquidity. And what you often see is once you are on the sell side of the curve and you are entering phases of distribution, you will see that often internal range to external range liquidity is the protocol. And that's what I'm then looking for. And that is what we have here. We see the market trade up into a short-term premium, up into this SIBI and this bearish breaker. And this is the moment where I drop down into the lower time frame, looking for a market maker sell model, anticipating the market to decline lower towards this low, and specifically this previous week's low, since that was my daily external range liquidity draw. Another confluence that I had here was that we had a large discount opening range gap, which was over 120 handles. And as learned in the most recent ICT lecture, was that price can leave the opening range gap unfilled and continue to trade in the direction of the gap when it is larger than 120 handles. And this in itself is of course a confluence, but 120 handles, it's kind of relative. I hope ICT will go into that at a later point, but some data ranges are of course way larger than others, and some are way smaller. So it's kind of, and also if you look back in time, 120 handles 2 years ago was, let's say 4 years ago, was extremely large relative to what it is today. So that's the thing that I would like to know from ICT, because if this is a rule of thumb, 120 handles and price can leave the gap unfilled, what about 4 years ago, when 120 handles was much more and much rarer than it was today? What are the rules to that? So although I like how it can be quantified, and in backtesting it seems to be the case more often than not, and that is the scenario, especially when we have a sell side draw below. But what about how will it be in the future when, let's say in 5 years, we won't be trading at 21,000, but perhaps at 30,000, considering what you have seen in the last 5 years. That could be the case, perhaps. Who knows? At least at some point. And then 120 handles will be nothing when it is compared today. But let's go back to the topic. I anticipated the opening range gap to stay unfilled and the market to continue to trade in the direction of the opening range gap to target the previous week low. This was another reason why I did not anticipate to see the market to retrace up into this new week opening gap, and can confidently look for short entries to target the previous week low without expecting the market to retrace back up first before doing so. Alright, this is the 1 minute chart. You can see the executions here. It was a 3-hour trade. I took a partial. I like to take usually at least one partial. There's just a very simple generic concept that is called 2-tap, where you basically take one partial and then take a full exit on the next time you take your position off. So you just take one partial and then full exit, and that's what I usually like to do. And specifically, I like to, in a market maker sell model, I like to take a partial at the discount array, discount fair value gap, or the low below stage 1 accumulation, and then I like to exit one handle below the original consolidation low. That's what I usually do. But in some instances, you don't have to really clean, clean is perhaps not a good word, but you are part of a higher time frame continuation, so the original consolidation is not as defined. In this case, this was the original consolidation of this small 1 minute market maker sell model. In that case, I would just take something off below that original consolidation low and then exit below the higher time frame sell side liquidity draw, which then usually resides just below it. So I entered here on the basis of the first percentage fair value gap. I'm still a bit critical. I don't think critical is the right word, but a little bit skeptic still. I've done my back testing, but I think I need to look perhaps a bit further into it. But I think the first percent fair value gap, it's not like an holy level, and I knew that was not the case, but you still have to have an undrawn liquidity and a narrative in mind before you can use it. So it's not like a very... I'm trying to figure out what the significance really is of that first percentage fair value gap, since if this was not 930, then let's say this was the first percent fair value gap formed here. Well, then it would still pan out, but let's say it formed here, then you could use it as an inversion. What I'm trying to say is, what is really the significance of the time element of the first percent fair value gap? What is what differentiates it with a normal fair value gap, like the one we have here? What is really the key difference between the two? You could say time, but why? Because there are also instances when the first percent fair value gap just fails to deliver, and then price trades through it, and then on the very next fair value gap, price finds resistance and then continues to go lower. So what is the significance of what is really the difference between this fair value gap and other fair value gaps? Because I can extend other fair value gaps also out in time, and I would see also similar support and resistance ideas. So that's what I'm still trying to figure out, but I'm not trying to go too deep into it, and I myself want to keep things very simple, although I'm curious to know more about it. But I used standard deviations defined by this manipulation swing, so the low, then the low prior to the manipulation to take out buy side liquidity. I define it by that high down to this low, and then do standard deviations to the downside and look for convergences between levels I already predetermined as strong liquidity, and look for overlap between them. We have one here, we have minus 3.5 in the old previous week low, and that's what I then targeted for a 3R trade. It was a little bit less, of course, because I took a partial in terms of what I got in percentage return, but the idea was good. Oh yeah, one more thing, I usually look for a convergence between this in the market maker cell model between the buy side of the curve and the sell side of the curve. And if you see here, we have a mitigation block overlapping with that fair value gap, so that's another confluence. Why would I outline this as a mitigation block and not a breaker? Because this overextended, so we have a high, a low, and then a higher high, but it is pretty overextended, like a very long arm is what I also always think about when I see this. It's like a very long arm extending far to the right, and that makes it to me a mitigation block rather than a breaker block. For a breaker block, I like to look at a high, then a low, and then a very next higher high, which is then in close proximity and just very violent, taking out buy side liquidity. And this is more like a overextended high. So I define that as a mitigation block. And I'm looking for that convergence with a fair value gap which resides inside of that mitigation block. So I have then a convergence between the buy side of the curve and the sell side of the curve. And as you might know if you've studied market maker models, old accommodation becomes a new distribution on the sell side of the curve in the market maker cell model. So after I traded the sell side of the curve, this market maker cell model, I saw a likelihood for price to potentially reach up higher, at least into this market maker of a first percent fair value gap. So the market at what I expected to see a reversal, at least to reach up higher. It was more of a retracement, but as you can see, we had a turn here, then the market expanded higher, and I thought, oh, we have buy side liquidity resting above relative equal highs. We have this opening range gap here, so I was actually targeting the opening range gap since we met that previous week low sell side liquidity draw. I thought price could reverse now, at least up into this opening range gap, since we took out significant sell side draw. So I was looking for the market to show its hand, and I was actually trying to enter off this fair value gap first, but I did not see the retracement lower into this gap. So then the market continued to expand higher. We formed this redelivered rebalance. Buy side delivery, sell side delivery, buy side delivery again. Balance price range, I entered off that. Rebalance inside of this 5-minute inversion fair value gap. So anticipated this gap then to stay open since we have this redelivered rebalance here in this 5-minute inversion fair value gap. And I was specifically looking to take a partial, which I did here, at the first percent fair value gap, and I look to exit my second contract above this buy side liquidity pool inside of the opening range gap. That was the idea. So I basically traded initially a market maker sell model, and then it went over into market maker buy model. I was trying to trade that, or you could say this was the sell side of the curve of a market maker buy model, and this was on the market maker buy model itself. It's all really connecting to each other. It's basically going for market maker model into market maker buy model and then into consolidation, and then continues to do the same thing like that. Or you could say consolidation is a lower time frame market maker or market maker sell model, but that's just all fractal and all connected with each other. And that's what I really like to study, those fractals in price. But I pyramided here, so I initially entered long here with one contract, and then so that was a pretty abrupt disruption of the recording, because some neighbor thought it was an excellent idea to try to drill a hole in the wall in the early morning. But let's go back to where I was going on with the topic. I saw price then showed significant displacement to the downside, and once price closed below this fair value gap, I thought this was most likely not going to cut off. I actually hesitated too much here. I should have actually cut it off right here when it was violating the midpoint of this order block, but I hesitated a little bit, and then eventually I cut the trade off once it traded below mean threshold of that bullish order block on this very next candle, and tried to save my stop. So this was only like a 1 point something R trade at most, but at least I added something to this account by taking a partial off here, which is again why partials I need to do it more often. I have the 2-tap, but I caught myself sometimes in greed. I think that's my biggest opponent, because I've seen it so many times play out that sometimes I'm getting too willful and seeing the original constellation high being traded above, but there are just cases when you are wrong, and the best partial really is the premium fair value gap, or basically premium fair value gap in a market maker buy model, since that is the moment when you will most likely be wrong in a market maker buy model, because then is just a market maker buy model, which is basically a optimal trade entry short and then turn into a market maker sell model, and that happens at a premium PD array, often a fair value gap in premium. So that's why it really is a good a place to take a partial, and which I should do it like always, because it really pays off. Because if I wouldn't do that, I would in this case had a break even or a small profit, since I entered already long here. But there are cases when I perhaps won't do that, and then it rolls back on me, either a break even or a complete reverse on me, and without me taking anything off, even seeing price go in my favor. Whereas if I would take a partial, I either have a small profit or mitigated it, and that's really gonna add, perhaps not on this trade, but over a series of trades, you will see that taking all those small portions off instead of holding to full terminus really pays off. And it's also just better for my mental state, seeing, knowing that I was in profit, that I take at least something off. Even if I'm wrong, I still took something out, instead of always holding for that full terminus. That's really something I need to work on. But yeah, it was a very insightful day. I did not take any other trades this day, but it was definitely a very helpful, insightful learning day. So this is going to be it for today.